Good afternoon and welcome. I know this is a Sunday afternoon and you've taken the time from the family to spend time with us learning about this new investment opportunity brought to you by Rice Capital. It is Anchor Retail in Fairfax, Virginia, and this happens to be an open-air shopping center. The opportunity, the strategy is to actually do value add on the shopping center and then exit the investment. I'm joined today by Heath Binder. He is an SVP at LBX Investments, who actually own the project and are executing this project, and then they are specialists in this domain, which Heath will talk to about their experience and what they've done in the past and what they plan to do on this particular opportunity. The obligatory disclaimer, there will be information that is forward-looking, there will be projections, there will be a lot of information for you to actually absorb, not only in this presentation and the discussion, there will be information that is shared offline as a part of the listing. I will walk you through the various documents and so on that will give you a lot of information. But at the end of the day, you will have to do your own due diligence and get the right kind of advice to be able to make your decision for investment. So that's essentially what this is saying. Quick summary of what this is. The domain is open air retail, and it's a category of retail in the commercial real estate space. And this particular opportunity is located in Fairfax, essentially adjacent to the Fair Oaks Mall. We, Rice Capital, Pavan and I are part of Rice Capital. We are the sponsors, bringing this opportunity to you as an investment where we are pooling these investments from several of the investors and essentially taking one check into LBX into that particular opportunity, and we become limited partners. So Rice Capital or its subsidiary becomes a limited partner in the LBX investment. And you all, the investors into this particular opportunity, would be limited partners in this vehicle that we float as Rice Capital. The project owner, executor of all of this is LBX Investments, and they have a lot of experience in this space, and you will hear about that. Our investors who invest in Rice Capital, the projected hold period is 2 years. The target IRR to you as the investors into this vehicle is 20%, and the cash on cash is 6.3% average, and hurdle rate is 7.2. We'll talk more about that at a later point, but I want to make sure that I land this numbers. The size of the investment, each unit is $25,000. So yes, you can invest in one unit, but our suggested minimum is 2 units, but you can invest in one. The closing date, this is on a very short leash. It was a very exciting opportunity that we wanted to bring to our investors because it's a class that a lot of them may not have invested in. And the closing date for that is literally Friday for the funds to come in. I'll show you and walk you through the RealtySlices listing later in the presentation. So as I mentioned to you, I'll introduce Rice Capital, followed by the actual project and everything that is being done on the project about LBX Investments and who are the principals and what their experience is. We'll spend tremendous amount of time on that to make sure that you have a good understanding about all of these from Heath. After that, I will walk you through the listing and also show you, talk to you about the structure and the dates and deadlines for how to make the investment. And then we'll have half an hour for questions and answers. We expect to finish the first 3 items in an hour. A lot of you know us, myself and Pavan. I've been in the industry for about 30 plus years and real estate investing, both active and passive, for about 12 plus years. I have done several deals in this domain and have been at Microsoft in general management responsibilities for about 14 years. Pavan, who was also with me at Microsoft, he was at Microsoft Dynamics. He founded Crowdseed Investments, which was the first sponsor of a project on the RealtySlices platform. He's been, again, in the industry for 15 plus years, 12 years of active projects, and in the technology industry for about 22 years. So real estate, he has good both active and passive, and as a developer, he has a lot of experience that he's bringing to bear. And we together formed Rise Capital, where we identify various opportunities and take a slice of those large opportunities and bring it to the RealtySlices platform as a sponsor. And now I want to turn it over to Heath to describe everything about the anchor retail opportunity in Fairfax, Virginia.
Great. Am I up?
Yeah, you're up.
All right, perfect. Thanks, Nagesh. So we are. So I'm going to tell you a little bit about LBX Investments as a company, and then we're gonna talk about the opportunity. We're owners and operators, as Nagesh said, of open air shopping centers across the country. We have acquired over 400 million in purchase price in assets over the last several years, and we've done very well for our investors. This particular portfolio is it's very interesting opportunity. We are buying it from a REIT that is liquidating. So you have kind of a unique situation where a company is selling assets because they're basically selling off the company, and we've been able to take advantage of that situation and place under contract what we think are two really great pieces of real estate. We are going to talk today about the Fairfax asset. Nagesh, do you want to go to? But I want to talk a little bit about us. So, our team, like I just said, LBX has acquired about 400 million of assets since 2018. Prior to that, we were in a different partnership, pursuing pretty much the same strategy. So all in, we've acquired about $460 million worth of open air retail over the last several years. You can see from the slide, we will talk a lot about our platform, and we can talk a little bit about how institutional shifts and allocations have impacted our space as well. But I think, and Nagesh, you can go to the next slide. I think the best starting point for retail, because a lot of investors, we see is a lot of investors have spent the last several years doing very well in spaces like multifamily, which is a space, by the way, that we have extensive experience with as well. Our two managing partners, one was CEO of a public multifamily finance company, and the other was Phil, was his right-hand guy. But you look at sectors like multifamily, self-storage, mobile home parks, these have been very, very popular the last several years. And what we've seen over the last, call it 18 months is, multifamily in particular. I mean, look, there's certainly, I'm sure, some good multifamily deals out there still, but there were, many, many situations where people invested in deals at pretty tight cap rates, and expecting there to be, pretty aggressive rent growth and cap rate appreciation, and there was floating rate debt involved, and in some cases it was capped, in other cases it wasn't. And now you look at what's going on in that sector, and there are a lot of investments in multi that are underperforming. Retail's kind of an interesting space from the standpoint of, we have seen institutions begin to shift towards our space again, because we are I would argue the sector that offers the most attractive yield profile of any of the major real estate sectors, and then also B, our retailers have actually performed really, really well. I think if you go back to when we first started looking at the strategy several years ago, there was a lot of noise at the time. There were concerns around Amazon, and you heard this term retail apocalypse. That was you can stay where you were, Nagesh. You can go back.
I see. Okay. All right.
Okay. I'm going to talk about Rob and Phil. But you heard the retail apocalypse. You heard, you saw some major bankruptcies. A lot of it was centered around malls. But you saw companies like Sears go bankrupt. You saw Toys R Us go bankrupt. These were kind of high profile companies that at the same time that the Amazon effect was gaining a lot of momentum, and there was this big narrative out there. You saw these kind of these stalwarts companies have been around for a long time that were going out of business, and so there were a lot of people running from our sector. And so what Rob and Phil, and I joined up with them in 2016 and have been with them ever since. But their general kind of high level thought was, if everybody is running from retail, that creates opportunity, because when everybody is paying too much attention to a narrative, you end up getting groupthink, and everybody goes in one direction. And certainly, if you just think about the fundamentals of retail, quite often it sits in the best part of town. It sits, in Main, right in the center of everything. And they really started digging into that thesis around that time. So let me tell you a little bit about them, and then I'm gonna talk about our platform, and then I'll come back to the retail sector.
And please talk about your experience too.
Yeah, well, Nagesh and I have known each other a long time. I used to run investor relations for a crowdfunding platform before going over to the buy side to be with Rob and Phil. I've been in commercial real estate for most of my career, more than 20 years. Working with investors like the folks on this call. This is what I do, and I really serve two functions at our firm. One is I work with investors who are looking to put money with us, and then two, I also oversee all investor reporting and communications. So what you see if you invest with us is on a quarterly basis. As most sponsors do, we will send reports and distributions to our investors. We put a lot of time and effort into the reporting to make sure that whether you're investing in one unit or whether you're investing a much larger amount, you should always, as an investor, understand how your investment is performing and have a really high level of transparency into how we're executing on the strategy that we've laid out at the beginning. So that's my role here at the firm. As far as Rob and Phil, again, Rob was, you can see on the slide here, he was CEO, president, CFO. He was basically in all the key corporate positions all the way on up to the top, reporting directly to there's a billionaire named Stephen Ross, who's one of the largest real estate owners in New York. Rob reported directly to him. Phil ran capital markets, was Rob's right-hand guy. They ultimately sold this company that they ran called Centerline Capital Group. They sold it and then did some different things for a couple of years. Rob was in private equity in New York. Phil moved out to the West Coast. I met him at our former company, and that's how I got together with these guys. If you look at the key management attributes on the right, a couple of things I would say here that really set us apart. One is we do as a company, we have extensive capital markets and operational experience, which really, really matters. I think a lot of times, as an investor, you'll look at a deal and you're thinking about, you're investing in the equity side of it, and you're thinking about how how the equity is going to perform. But there's a relationship between the equity and the debt, and we really, in terms of how we structure our deals, there's just really, really extensive experience and relationships at play there that really do matter. Case in point, in 2020, when COVID hit, our portfolio actually ended up, the metrics across all key metrics across the portfolio improved in 2020. And a major driver for that was because we had really, relationship-oriented, flexible debt in place that helped us navigate what was historically a tough time for everybody across many different industries. As far as our track record is concerned, like I mentioned, we've acquired 460 million or so of deals. We've had one deal that's gone full cycle. We've had multiple deals where we've stabilized and returned significant capital to investors, either through refinancing or selling off parts of the deal. And we've just generally speaking been performing really, really well, at or above pro forma across our portfolio. It's the strategy really has played out so far the way that we've anticipated. And I'll walk through why that's been the case. Nagesh, you want to go to the next slide? So you can see how we're located around the country. So when you look at people in kind of key positions, there's extensive experience across the platform. You've got, I'm out here in Los Angeles with Ethan, who runs acquisitions for us. Ethan's a little bit actually on the younger side. He works with Rob and Phil on all acquisitions, and he has a team under him. He's exceptionally gifted, a little bit lighter in terms of years of experience, but never get the chance to talk. Extremely knowledgeable underwriter. Reza runs legal for us. We have we're vertically integrated, so we have construction management, leasing, asset management, property management, just all accounting. All key functions, both front office and back office, are all vertically integrated. One area where we differentiate ourselves is on the leasing front. We work with a network of third-party leasing firms around the country. And that's really important because when you're buying a deal, you want to have local boots on the ground. It really does help move the needle with key value add strategies. You can go to the next one, Nagesh. So something we always talk about is why LBX? What's our secret sauce? The first thing I'd point out is retail is a very high barrier to entry sector. Certainly, you could go and you could buy like a $2 million asset, something small, but the type of retail we're buying is generally, the assets are generally on average, 20, 30, sometimes larger, 20, 30 million. And to acquire and operate the types of assets that we do, you need to have a really top shelf infrastructure in place, which, as I just kind of walked through quickly, it's something that we've built over many years. In terms of relationships in the industry, we have, you can see over on the right, we have relationships with, all the big national tenants that you need to have relationships with third-party partners, and brokerage firms, et cetera. We have a just significant presence in our space. And it's not something, like for instance, going back to multifamily, if you want to go and buy a multifamily building, it's actually pretty easy. You go and if you can win the bid, you find a third party manager and, you're good to go. And you can actually, it's one of the reasons I think why there's so many people in multi, but retail is it's got more moving parts. It's more challenging, but once you have an infrastructure like ours, we're well positioned to continue to grow and operate our assets. The number 2 on this graphic, operational skill. This is a really, really important point for people to think about. So, if you've looked at how you can look across sectors over the last couple of years, and you can look at a track record. And lots of people have done really, really well, right? Like say you bought an asset in 2018 and sold it in 21, and you generated a 30% IRR, and you look like a genius, right? Well, we're in a different environment now, and the environment going forward is harder, right? Money is not as inexpensive as it was. It's become a lot more expensive, and when you have an environment where there's more uncertainty, in our view, it really favors groups like us, which, we roll up our sleeves and we're very active operators. But I think that as you're evaluating us as a company, you really want to pay attention to the people that we have in place and our ability to execute in our plan, because retail in particular is really a sector where you can generate alpha by being very hands-on managers. And in fact, a lot of times what we like to do is buy from large institutions, because it's funny, I was looking at a deal that we did yesterday. Someone asked me about a correlation between the deals that we're going to talk about here, or the deal that we're going to talk about here, and and the seller and their stock price. And which is, it's not a correlation that matters. But I looked at a deal that we had bought in 2018 from a specific REIT, and that REIT stock price has been completely flat since 2018, hasn't budged. But the deal that that I was comparing it to is we have an offer on it, and it's about to generate call it a 20% return, give or take. When you actively operate assets, you can generate a lot of outsized risk-adjusted return in our space. Going back to my comment about reporting, transparency is very important to us. Every quarter we will give you very detailed reporting, which will tell you how the asset's performing relative to its strategic plan. You'll see full financials. You'll see leasing metrics. We really do believe that we have best-in-class financial reporting for investors. And then the cycle-tested comment. So, we've all been in the industry a long time. We've seen multiple market cycles. This is, not a even though LBX was formed in 2018, this is not a group of people that has never been through, adversity in our sector before. We've been around a long time and have seen, seen good times and bad. So that's very important to factor in when you're going to put your money with somebody. Nagesh, you can go to the next slide. So speaking about some of the fundamentals in retail, right? Because I know for a lot of folks it's a new sector. So the very first area that I pretty much these days always point people to is just a simple supply and demand chart, or a couple of charts here, which really speak about the imbalance in the space. So if you just think about how real estate works, right? Let's look at other sectors where you can just continue to build, right? What you've heard stories, like let's say you buy and again, this is just a general story, but say you buy like a multifamily property in Houston, right? The rub is that there's nothing to, if the market's hot, there's nothing to prevent somebody from just going down the street and, putting another shovel on the ground and adding to supply, right? And I'm not being negative towards multifamily. It's just you're looking at, supply trends in different sectors, which are, you just see a lot of development in certain areas. Retail is the exact opposite. So since 2008, when you had the Great Recession, there was some overbuilding that took place prior to that. You can see the chart on the bottom left here. But once the Great Recession hit, there was hardly any new retail supply added to the sector. And that's been a trend that's continued and is expected to continue going forward, into the foreseeable future. When we talk about retail, right, we talk a lot about, I think you can see it on this stat here, right? There's call it 911 million square feet, give or take, of retail in this country. You have to segment it. The sort of retail that we buy, we're not buying enclosed malls that are dying. We're not buying, retail that's off the beaten path, that's going to be turned into something else like self-storage. And we're not buying these huge projects that are in, places like downtown Seattle or downtown Los Angeles, or not downtown, like in Santa Monica, there was a 1 million+ square foot development, a few years back, which has, all sorts of high-end tenants in it. That is not what we buy, right? What we buy is retail that we generally are looking for. It's open air. It's generally the, number, we think like one of the top 2 or 3 assets in its submarket, right? And there's no more of that being built. And the reason it's not being built is because it's just the economics of it. the retailers that you want to be exposed to in our space, the ones that are growing, they do not tend to pay really high rent numbers. So that means that your cost of construction is not going to justify getting them as tenants. So what you generally see in our space is that if you have well-located real estate, you are going to be able to, that you can buy at a good basis, you're going to be able to attract those retailers because there just is not that much space and it keeps getting filled. And box vacancy is at a historic low. And if you look at retailers that have gone out, I mean, there's a little bit in the press right now. Bed Bath, obviously, they hit the headlines, the other weekend. This has been going on for several months. Bed Bath was not news to anybody in the industry. It was, front page news for CNN, but we are, it's not like anybody was surprised by it. But what you can look at, and I can send Nagesh a link after this to some different articles on it. What you're seeing is that all these strong retailers that continue to grow and expand are trying to snap up the old Bed Bath space because there just is not a whole lot of vacancy. It's a really defining characteristic in our space. And it's why across our portfolio, we've been able to just consistently sign large leases, small leases at what are called leasing spreads, which are well above what we've underwritten. We're very conservative underwriters, and we've basically seen really fantastic leasing activity across our portfolio from retailers like the ones you see in the bottom right. And what I'm talking about from a demand standpoint is I think best exemplified by the chart in the bottom right, which is it's just average annual change in store counts. These are all public companies. You can go to their quarterly or annual filings and pull the information yourself if you want. That's what I did. And you can see that some of these names that let's go through them left to right. Ross, Ulta, Walmart, Target, Burlington, Five Below, TJX, Dollar General, Costco, Chipotle, Dick's, Hibbett Sports, City Trends. These are companies that have been growing. They grow through good times. They grow through bad times. They have really solid credit profiles. They are strong companies. They are not going away. And when you're exposed to that sort of strength of tenancy, and you own, what is one of the better pieces of real estate in a good submarket, our view is that you're generally going to be really, really fine. And that's been our experience as we've grown the company. All right, Nagesh, you can go to the next one. So something we talk about too, we don't field as many questions around it now as we used to. If you go back 5 years ago, the quote unquote Amazon effect, it was the number one question that I got from folks. I mean, every single person I'd speak to would say, yeah, Amazon's going to put retail out of business, et cetera. And, in fact, it's not the case. What we've seen as the last several years have progressed is, a bunch of stuff. We've seen, first off, that there are no profitable pure play e-retailers, right? Brick and mortar is still the dominant way that people go shopping. It still counts for, plus minus 85% of overall retail sales, right? E-commerce as a standalone is not profitable. So what you've actually seen is a lot of the e-commerce companies, they've actually started opening brick and mortar chains. I mean, maybe the best example of this is Amazon buying Whole Foods, right? Online is super important. We are not naive to that, and I mean, look, I'll be the first person to say that, we get Amazon packages every day, right? My wife loves to, press the button on her phone. But what you actually are seeing is an evolution in retail where, first off, the traditional brick and mortar retailers, most of them have invested heavily in online platforms. So now, to the extent that, like, for instance, Dick's Sporting Goods, in their most recent quarterly report, said that their margins on, online and offline were, now roughly equivalent, which is a really interesting metric, because that was not something that anybody would have thought years ago. When you look at, the top retailers, most of them have, I mean, look, they have different channels, right? And so, you can buy online, you can buy on your phone, you can buy in store, you can do what's called BOPIS, which is buy online, pick up in store. From their standpoint, they just want to get you in, and they just want to get your money, right? They want you to buy their product. And there's different, areas that, there's there's different reasons to buy different things in different ways. If you're a big retailer, you've invested heavily by this point in both online and offline fulfillment, and it's this whole idea that Amazon is going to come and put the brick and mortar guys out of business just has not played out at all. And going back to the demand slide, what you've been seeing is actually store openings have just continued to outpace store closings. And if you go back to my comment earlier about COVID, right? You've actually seen, look, like Bed Bath is obviously a big headline, but for the most part, you've seen a lot of the weaker retailers. They were finally put to bed by COVID, and a lot of the issues that you had were not with retailers closing. Prior to that, were in malls, and a lot of times it was bad business models that were over leveraged. It wasn't because of Amazon; it was because of just companies that had too much debt and couldn't invest their free cash flow in evolving, right? So the types of retailers we work with, and this is a consistent theme across our portfolio, are strong credits that these are profitable companies that are not going away tomorrow, anything like that. They're all in a good financial spot. All right, Nagesh, you can go to the next one.
Yeah. Any questions that you have, please put them in the Q&A so that we'll be able to handle them. And if there are related questions, we'll be able to group them so that we can have a good flow while making sure that everything gets answered. If we are not able to get to any of the questions, we will respond offline. Yes?
Yeah, for sure. So just one quick case study of, which is relevant to, it's relevant to the Fairfax deal. We bought and it's going to be relevant to the Orlando deal as well, which I think we're going to talk about next weekend. We bought a center in 2018 called Alafaya Commons. Alafaya is very close to the University of Central Florida, which is the second largest university in the country. It's at a corner, you can see in the bottom left. Down there. It's on a hard corner that gets about 100,000 cars a day. When we bought it from a REIT. That REIT is, it's a good REIT, but they were not actively managing the asset. They had acquired it in a merger, and when we did the first tour, their asset manager was walking around introducing herself to the tenants because they had no relationship. So that was a deal where we bought that at around a 9 cap. So we bought it for $20 million. It was anchored by an Academy Sports, which was viewed as a credit risk at the time. For that deal, we viewed it as what's called a covered land play, where our downside risk was very protected because if Academy ever went out, we could sell it to a residential developer for land value, but we were clipping double-digit cash flow. What we've done at that asset is we sold off the Academy box. We've sold off 3 out parcels. We sold off the Academy box at an 8 cap. We sold off 3 out parcels. One we had re-tenanted with a Jollibee and sold off at a 4.3 cap. One I think was a 5.25 cap, and the other was around a 6 cap. We've returned significant capital to investors, and then we refinanced. So investors are now in a position where we're in the market on this one. But investors are, basically in a position where we bought it for 20, we returned something like, I think it was 12 and a half, right? So everybody's basis was down to, about 7.5. And now what's left is worth 15 to 16, something in that neighborhood. So it just really speaks to the sort of value creation that you can see in retail if you can execute on a business plan. Nagesh, you can go to the next one. So let's talk about the portfolio. And you can go to the next. So again, we're going to talk about this asset, and then there's an Orlando asset next week. So I'm really just going to speak about Fairfax today. But here are 5 key themes for investors to focus on. So first is the real estate's very high quality, and you have a seller that is liquidating. So because of that, it puts us in a position where we've structured financing to acquire these deals where we have what's called future funding. which is basically cash set aside to sign new leases. So that puts us in a really good spot to execute in our plan. The assets have really strong credit quality. So when you look at the tenants, for Fairfax, the two main tenants here are, you've got Dick's Sporting Goods, which is, one of the, if not the strongest retailer in the entire space, certainly the strongest in sporting goods retailers, investment grade rated, just a, real behemoth of a company. Also, they have a subsidiary called Golf Galaxy, which is a real destination draw, which is at the location. And then we have a Dave & Buster's, which, they do very well here. And, Dave & Buster's had some issues during COVID, just because people were not going in restaurants, but they've rebounded really strongly. They made a large acquisition of a company called Main Event last year, and they just reported record quarter results. So, really, really strong retailers. There are, multiple value add opportunities here, which is good from a diversification standpoint. Also, you have significant downside protection. Again, just speaking about the credit that's here, there's also a Lazy Dog Cafe, but they're smaller. But speaking about the credit that's here, the tenants are here, got in-place cash flow, and the tenants are here over the long haul, right? The weighted average lease term extends far beyond. I have to look at exactly where the leases are, but I think they run for the next several years. And we're talking about a 2-year targeted hold period here. So we've really good downside protection from the standpoint of, you have contractually obligated rents from really strong, financially strong tenants that are in place. And then also one other comment is, we always, as a matter of practice, we always certainly we like to make investments as tax advantaged as possible for our investors. So we'll utilize whatever we're allowed to with the law in terms of bonus depreciation, and we'll cost segregate assets so that we can accelerate depreciation. Again, the goal is to really maximize the tax benefits for folks. Okay, Nagesh, you can go to the next slide. And then just a couple concerns to address up front. So one is, so this one is next to a mall called the Fair Oaks Mall. The mall is a strong mall. It's a B mall, so it's not going to be as fancy as, say, Tyson's Corner, but it's got an Apple store and a bunch of solid tenants. The occupancy per the most recent annual report is it's around 95% occupancy. And then, anecdotally, we've been told that it's achieving more than 500 a foot in sales. So, from sources that we have in the industry. So it's a solid, you should look at it as a shadow anchor, but, we're not tied to the mall, right? So there is something called an REA, which I'll get into in a little bit, which there is a relationship with the mall, but we don't have to, for instance, like pay for the expenses in the mall, which are quite high, right? That's not part of this. This is a standalone asset with the Dick's, Dave & Buster's, and Lazy Dog. Next comment is that returns are not being driven by aggressive underwriting. So something about, kind of going back to, and we talked a little bit about dynamics driving the retail industry. We are not aggressive underwriting, and these deals do not follow a typical trajectory like you might see in a sector like multifamily. We're not buying things at kind of tight cap rates and then hoping for aggressive rent growth and aggressive exit cap rate assumptions in order to achieve our numbers. This is a really important point for investors to understand. The way that we get to the types of returns that we target are through, there's multiple value add strategies, but the two biggest ones are, targeted leasing efforts, right? Which you're playing on that supply demand imbalance. This is a very, very tight submarket, and I'll talk about that. There's just not a whole lot of available box space. So, where we're really, leveraging here is, the strength of the submarket and the strength of the real estate and our ability to attract, a retailer or two to the space. It's not being driven by a bet on where interest rates are going to go or, where cap rates are going to go or really aggressive underwriting. We actually underwrite expense growth at a higher rate. So we typically in our model will underwrite market rent growth at 1%, and we underwrite market expense growth at 3%. I talked a little bit about this third bullet before. Well-located retail continues to perform very well. This is, really something that we see across our portfolio. All of our assets are performing. The lease structure, a lot of the leases, the way that retail leases are structured is they're either triple net or, there might be something called modified gross. But the main point is that you incur expenses and then you're billing back some element of those expenses to the tenants, which is really protective, particularly in a rising expense environment. We use positive leverage, so that means the cost of our debt is lower than our going in cap rate. And also, comment I would make there is, we also stabilize. We always project a stabilized yield on our deals. We're projecting a stabilized yield here that would be a few hundred basis points higher than the cost of debt, which is again really protective. And then I talked about credit quality. That's really important, right? Credit quality is simply what do you think that the retailer is going to pay their rent, right? Are they going to pay their bills? And if you have a strong credit, that's not a bankruptcy risk, then you're going to be in a much better spot than if you have if you had a Bed Bath & Beyond as your tenant 6 months ago, that would have been a really high risk because that bankruptcy risk was floating out there, and if they go bankrupt, then your rent is at risk. So it's something we pay a lot of attention to, is that credit quality. And then finally, all the debt is in place and fixed. We don't like to mess with floating rate debt. We want to make sure that through the life of this deal, and it's 5-year debt on a 2-year targeted hold. We want to make sure through the life of this deal that we're just not subject to interest rate risk. It's just not a risk that we like to take. The funny thing is, if you talk to us, I don't know, 7-8 years ago, they're investors. I'd call up and I'd say, yeah, we're buying a shopping center. They'd say, retail, are you crazy? I want to see multifamily. I want to see industrial. And we're actually pretty conservative. We're value guys, and this is where we've seen the value. All right, Nagesh, you can go to the next one. So here's the Fairfax deal. You can see just an aerial of it. You got the Dick's with the Golf Galaxy and the Dave & Buster's. It's about 200 and almost 213,000 square feet, and it's really two key value add plays here, right? One is there's a 58,000 give or take square foot box that we'll look to lease, and then the second is there's an out parcel monetization opportunity, and then there's operational fixes too, but that's smaller stuff. So it's really the two areas that investors should focus on the most are the lease up of the box and then the out parcel. I guess you can go to the next one. So first, we should talk a little bit about Fairfax. Fairfax is a very affluent market. We've actually been trying to buy in Fairfax and surrounding Northern Virginia suburbs. We've been trying to buy there for years, and it's been, frankly, it's been impossible to see anything that's made sense. The cap rates have been really, really tight. It's just been, we've gotten close, but it's just hard to find value there because it's such a institutional market. There's so much affluence there. There's so much growth. And you have the government, which good times and bad times. Historically, the government in this country keeps spending, and so DC and the Northern Virginia suburbs tend to have they tend to be viewed as pretty recession resistant, which is nice. But so your average household incomes within a few miles are north of 200,000 a year and projected to get close to like 240,000, 230,000 over the next 5 years. So really strong affluent growing corridor with great traffic counts. You've got a couple major roads that kind of surround this property, and you're seeing north of 200,000 cars a day. Plus you have the mall, which is an important driver, and just we're right in the middle of a really good submarket that does not have much retail vacancy. And there are a lot of tenants that are kind of on the hunt, And go to the next one, Nagesh. So, the first strategic initiative is to, you'd see we, put the red box there. It's basically it's 58,000+ square feet there. We've tried to be very conservative in terms of what we've underwritten here. So we've underwritten only leasing up 40,000 square feet. Certainly we could do better than that. So, there are auto uses, actually, there are medical uses. There is a grocery use. There are soft goods uses. And then there are other potential entertainment uses. These are all in the market looking for space. And so, we'll see how these materialize. I mean, we can't go and, pursue any leases really until we close, but there has been a lot of interest in the market in these spaces, because again, going back to my comments about supply and demand, there just is not a whole lot of availability, and the availability that does exist. I'll give an example. There is a Bed Bath & Beyond box in the market, but it's vastly inferior. It's got much weaker co-tenancy, and it's got much weaker visibility. So when retailers are looking for where they want to be, the ability to be next to a Dick's and a Dave & Buster's that draw a lot of destination traffic is and a mall that draws a lot of traffic is a key selling point. But we've underwritten leasing up just 40,000 of this. If we do more than that, we'll do better. And then we've also assumed pretty conservative metrics in terms of what it'll cost us. We've assumed that it'll cost us more than it probably will to sign new leases, and then we've assumed rent that's below what we think we can actually achieve. I think we're assuming $15 a foot in rent and $70 a foot for our assumptions, and we've given ourselves 2 years to execute on this strategy, which is that's a lot of time. Go to the next one, Nagesh. Next is there's land. So what you're looking at, a box there is really land that could be earmarked for an out parcel. It's kind of an interesting dynamic here. So there's something called an REA. We need to get approvals from the mall owner in order to construct an out parcel here. An out parcel could be something like a McDonald's or a restaurant, just something that sits out by the street. Those trade when you carve those off and sell those trade at tighter cap rates than what you typically would buy a center for. So you can play that arbitrage strategy. It's something we've done to great effect across our portfolio. We've sold off. I think we're north of 17 million that we've sold off in our portfolio in out parcels and single tenant boxes over the last 5 years, which is a big number, and it's always at accretive cap rates, right? That's why you do that. When you sell off out parcels, if you're getting that accretive cap rate, what you're doing is you pay down some debt, you're delevering, therefore you're returning capital to investors and you're reducing your basis. It's a really popular strategy that we again have had a great track record of executing on. There is a document that governs the relationship between us and the mall owner, and then other owners. The Lord and Taylor box, that is owned by a different entity than the entity that owns the mall, which is owned. And then there's a JCPenney box is owned by a different entity as well. Now JCPenney is in there open and operating. The Lord and Taylor box is vacant. But the main point is there's an agreement that governs the relationship between all of the different stakeholders at the site. And what we're asking for is very little. Ultimately, if they have designs on residential development, and if you look at public transportation initiatives that are projected for this site, over the long haul, the expectation is that the mall is going to will welcome some additional uses, that there will be some residential when the market is better for it, that will, add on to the retail that's currently here. It'll become more of a mixed use destination. That's the general view in the marketplace. And so our ask is not very much, right? But they need our approvals in order to execute on much larger plans. So we feel that we have very good, negotiating leverage, and again, we have a lot of experience with this sort of thing. I guess you can go to the next thing. So just, kind of going back to what I was talking about. So first off, you have this very strong credit quality, right? Dixon, Dave & Buster's are, they have strong financials and strong weighted average lease term. And it's just very protective that they're there for the length of time they are. And, again, we know they both do very well here. You have, again, transportation initiatives, which are, expected to extend out to this site. Which are an important driver for the long-term real estate. I mean, we talk about this real estate a lot internally. We label it as generational real estate, which I think is a really fantastic piece of commercial real estate. We expect there to be alternate uses coming, as I just discussed, because of multifamily interests that are at play. And then again, there's very limited new retail space available. There's, when you have that supply demand imbalance in your favor, with, there's again, a lot of tenants that are, in the market looking, that's a great imbalance that we're going to seek to capitalize on. And then, a question we get is, about the debt. So actually these numbers have changed a little bit. They've improved. So the debt that we have in place is with a regional bank called HTLF. Again, I want to really stress this. We work with relationship lenders. We stay away, from CMBS, this highly structured sort of debt where if you need somebody, and you have to call some special servicer that's middle of nowhere and doesn't know the asset. That doesn't work, right? Because retail requires flexibility and we just across the board, we view our lenders as our partners, and having a good relationship lender is so key to what we do. So we're going to do a loan here. We have the fully executed term sheet. We're going to work with HTLF. The leverage is moderate. We're not high leverage guys. It's 5-year debt. It is, you can see 62.5 loan to purchase price financing at close. We have 100% of funds set aside for the lease up initiative, which is really important because leases do cost money. You have to pay tenant allowances, you have to pay leasing commissions, you have to pay, sometimes some additional construction costs. So we will have all of that money available to us. We have some interest only, so 18 months of interest only in order to, certainly helps with cash flow. And again, 5 years, right, which is, common for a bank loan that, gives us more than enough time in our view to execute on our stabilization strategy. And then the last thing I say, so the rate that we're actually assuming in our model, we will lock it at close. Rates have come down since Nagesh and I started trading materials, so we're actually utilizing a 6.35 rate right now. If we locked it as of Friday, it would have been, I think, 25 basis points or so below that. So we still have some cushion baked in, but rates have come down in our favor, which is great. So the one last comment is, this is not on here, but there's something that we look at called the lowest DSCR test. And that is basically, that's debt service coverage, right? Which is basically, that reflects your cushion, right? And throughout the life of the hold, based on our estimates, the lowest that it ever gets is 1.71 times. So we're covering our income by 1.71 times at the skinniest point in the deal. Which, that's a very strong coverage ratio. Just for comparison, and multi, a lot of times you're seeing, much skinnier, maybe like 1.3 or something lower. We tend to operate with coverage ratios that, by the time we stabilize, get up into, well north of 2 times coverage. So we're, very excited about this deal, and I think that's it. Happy to field some questions. Oh, well, I can talk about this too. So, I just talked about all this stuff. I don't think there's any, the only other thing maybe I'd mention here is, the high risk adjusted target returns. So, again, something that we look for a lot of in our space is we like asymmetric risk. And so, we like our deals where we have the, opportunity to achieve alpha, right? To achieve excess return, upside, but we don't like to take a lot of risk to get there. right? We're not cowboys. That's not who we are as a company. So, when you have deals where you've got really good credit in place, that's with, good coverage, that's very protective, and again, going back to the underwriting scenarios that I laid out, we've assumed 40,000 square feet, which, over the last, I have to look at exact statistics, but we've signed like 5 or 6 of these sorts of leases across our portfolio over the last 6 months alone. Our leasing activity's been really strong. So we can execute on 2 of these leases over the 2-year hold, and hit 40,000 square feet. That's the bare minimum that we've underwritten. We certainly think that we can do more than that. But we wanted to put a number in there that was really attainable. Because again, our view is we certainly want to do well by folks, but we don't like to overpromise. We're much more the underpromise and try to overdeliver types of folks. So I think that's it. Nagesh, you're on mute.
Thank you, Heath. So Nagesh, you're muted.
Yeah. There's one more that I think you talked about where Sears, after the Heritage guys, after they made the decision to sell the portfolio, they were not servicing any clients, any of the customers that the tenants, or getting any new tenants into their positions. And there is a list that's a backlog, right?
Yeah. So you're always dealing with I'd say speculation based, because we work with local brokerage partners, and there have been LOIs presented that did not materialize. I certainly don't want to comment on anything with respect to the seller, but I will say that we have funds set aside to capitalize on interest, and we know that there is a lot of interest in the market. As far as the question of I actually have a list which I'll pull up. So new retailers that have come to the market over the past 5 years. So you've had right, because I think, let's see, there's one question here. Can you please explain more briefly about the recent real estate growth in the area? So you've had Hobby Lobby, H Mart, PGA Superstore, Dollar Tree, Lidl. There's a company which actually I'm not super familiar with these guys because it's not a name that we've seen, but they actually took a large space. They're called Rockler Woodworking. So that's the market's got your all the different retailers that you think about are all here in Fairfax, but there's been a bunch of new retailers that have come to the market over the last 4 or 5 years.
Thank you, Dave.
In terms of a question of what occupancy we're looking at close, I can go to our pro forma and look. I don't know that number off the top of my head, because what we do is we assume some static. Let me see if I even have that. We assume some static vacancy. So if you're at 215,000 and we're leaving 18,000 square feet or so vacant in our underwriting, then you're what, 213. I can do it on my I don't want to do it in my head. I'll do it on the calculator. So 2 minus, hold on. So 194,675 divided by 212. Ballpark like 91.5, something like that occupancy, give or take, from an underwriting standpoint. We've left that space vacant, not because of any obsolescence with the space or because we can't use it. We just want to really be conservative on it. Certainly, we're going to try to lease up as much of it as we can. And in terms of ranking uses, because I think that's important, there has been some buzz around a medical use potentially, and if we could execute a medical use, that would be, that's it might be a little bit more expensive to do it, but your rents are higher, and as anybody who's ever invested in medical uses knows, those uses tend to be pretty sticky. So if we can execute on that, that'd be certainly our top choice. But there's also a grocer that's floating around in the market where there's apparently an LOI that's in the works, and that would be for plus minus, call it 30,000 square feet if we can execute on it.
Got it. Thank you. let me describe a little bit of the investment structure, the process, and walk you through the site first. Can you guys see my?
So Nagesh, we have one more question from the Q&A.
Okay, go ahead. But can you see the website?
Yes.
Yes. Okay, good. All right. Yeah, take the question, please.
You might want to pull it up, Nagesh, from the Q&A.
Okay.
This the one about the exit strategy? Or?
Sorry.
Yeah.
So what's the occupancy percent you already addressed? The next one was how much money is raised for this?
I mean, you have what? You have what, $1.5 million?
I mean, we just went live literally 48 hours ago.
Yep.
So we're first, this webinar is actually a prerequisite for actually accepting any contributions from anybody, because this is a part of the offering.
Yeah. So you guys have a $1.5 million allocation.
Right.
How large is what's the capital stack? Is that the question?
Well, we'll talk to that in just a bit. Yeah.
Yeah. Okay. Yep. Okay.
Okay. So when you log into, I want to give some orientation of the site that you would see once you log into RealtySlices and go to the marketplace. When you go to the marketplace, you will see multiple deals here, and the one that we are right now talking about is the one in Fairfax, and I think we'll have a follow-up webinar on Orlando. The Fairfax one that I'm just opening, typically, it has the heading and the vital statistics of the deal, a good overview description, followed by what the key metrics are to the investor. So targeted metrics are 20% IRR over the 2-year period, 1.47x target multiple, and 2 years of hold period. Then this is the location of the thing, and you can essentially click on this and you will get the full map, and you can interact and see what all is there around it. How is it located with respect to the highways? How is it with respect to other transportation centers, and so on? That gives you a feel for the kind of traffic that you would expect. In addition, I think he talked about the general demographics and the fact that the average household income is north of 200K. The capital stack, I think there was a question about that. Approximately 60% is debt, about 24.5 of the 40.9 million. There is a sponsor is putting in about 1.78%, followed by LBX investors that LBX has prior relationships with. They are bringing in about $15 million, and we are actually chipping in with $1.5 million of pooled investment. But Rise Capital is actually the sponsor and the investor that is making it to this particular thing. And individual LPs get into the float by Rise Capital, and then that goes in as a single check into this offering, into the equity stack. And here is information about what the 40.9 million is going into. The capital stack essentially is the same thing here, which is where the money is coming from. And here are all the information about where the money is going towards. As I mentioned earlier, 1.5 million is the equity stack. $25,000 is the minimum investment, and all investments are in units of $25,000. Our suggested is a minimum of 2 units. But of course, you can invest in 1 unit if you want it. And May 5th, which is the Friday, is the funds deadline for contributing to this project. So we are investing a check into LBX's opportunity. And the way the distributions work, and here is the waterfall. Maybe I'll talk about it at the waterfall. This is about Rise Capital. I think we just introduced ourselves, Pavan and myself. This is how all the entities relate between Rise Capital and LBX, how this is all coming together. There is Rise Capital, there is a wholly owned subsidiary, and it is pulling all the assets and putting it into the LBX entity. That's all. I mean, this is all it is, and this is the manager of it. Waterfall. So there is no commission or anything taken at all from the capital that you contribute, nor when it is returned back to you. Whatever LBX returns as invested capital comes back to you. And in the rest of the cash distributions, essentially 10% is taken out of those distributions, and between the sponsors, which is Rice Capital, takes 10%, and 90% of the returns are given back to you. So that's essentially how the waterfall works. And all the, so here are the risks, and you should take time to read through the various kinds of risks that this investment entails. Followed by, there are several questions that people have asked in the past of such investments, and we have taken time to actually answer a lot of the questions. Please come through that, read through the ones, and get back to us if you want some more color on those. And here are all the offering documents. Anything with RETVA or RC is Rice Capital. These are the ones that are related to the float from Rice Capital. These are informational things about the project itself. A lot of the information you got today from Heath, which goes into gory detail about every box, what is happening, and what is the strategy that they're following, where they have done this kind of playbook before, and so on. This is all the legal documents associated with the various entities in here, and take time to read through them. And this is the whole set, and typically Rice Capital and RealtySlices we float and give you all this information in order to make an informed decision. But in the end, you should understand it. You should talk to people. You should do your own research, and and make the investment decision. And we are here to provide you any information on this raise. And Heath, we'll route the questions that are specific to the project execution to Heath and LBX. And that's how we have structured the whole investment. Now, let me show you a bit about, I think I talked to this. So here is how the structure is. RealtySlices, so Rice Capital is the entity we talked about, who's the sponsor of this float. And it is 100% owner of RC Fairfax SC for shopping center. And this is the sponsor and manager, okay? And this manager is the one that is floating the investment on RealtySlices, and that's the one that we are describing today. Now, this particular shopping center sponsor is managing a particular RC Fairfax SCF for F for fund. And this is the LLC that actually takes the individual checks from the investors. And as a single check, we go in as an LP into their entity. And the governing documents, just to let you know, are, here are all the documents that are related to this particular float. And what we are responsible for is all the member management, investor relations, investor communication, logistics, tax and distribution, whenever distributions come, all of that, and including the float of this. So that is what we are responsible for. And LBX is responsible for full project execution and managing the entire investment on the sources and uses of capital, so that they're able to provide the right kind of returns for us.
Okay. And if you want to add to what Nagesh mentioned, this is going to be a 506c raise, which is meant for all the accredited investors. Yes. And Capital will manage all of the, meet all of the SEC regulatory guidelines, and will be the one that will be primarily be doing all the reporting to SEC.
Yes, that's correct. Thank you. Now, the key deadlines, if you will, right? We're doing the presentation actually a couple of days into it. All the documents are there, the PPM, all of the documents are available, just like what I showed you just now. Take the time, talk to folks, and actually the signing deadline for the PPM is 3rd, and funds received being the 5th. And we will take that weekend essentially and send the check on the 8th, and then file with the SEC on the 11th. So it's a pretty short period for us to do. But hopefully Heath has answered your questions and given you a good feel for why retail, why open air retail, why Fairfax, and what is the plan of action for this particular investment so that you can make your decisions on the information you've received so far. And it is a 506c filing, which means that they have to be, all of the investors in here should be accredited investors. And our suggestion is to use this service called verifyinvestor.com. And there are multiple bases for figuring out whether you're an accredited investor or not. And really at a high level, either you have individually 200,000 or more of income, or with your spouse, you have 300,000 plus of income, or your total assets, excluding your primary residence, should be $1 million or more. So these are the criteria, but then you can provide for any of these three proof to verify investor, and they will give you a legal document that essentially says that we have looked at this and we don't look at any of your personal information, your investments, your net worth, nothing. They are people who are attorneys who look at the information that you provide, and then they give us the certificate, and that's all we look for to make this investment possible. And so, to net it out, open air retail among the retail asset classes is really attractive. Anchor retail in Fairfax, this is the one that we are floating here, with the project execution being done by LBX Investments. And to net out the holding period, the metrics, 2 years of hold period, 20% target IRR, average investor cash on cash is 6.3%, and a hurdle rate of 7.2%. That means essentially after 7.2% is when the final distributions are distributed between the sponsor and the investor. The size of investment is $25,000. And as I mentioned, the minimum suggested size is 2 units, and we have 5/5 as the closing date. And this deck is also available as investor presentation so that you can go through and look at all the project details that you heard from Heath, and the investment details that you heard from me. And Invest Now, you can click right from here and be able to go through the workflow. The first being, the verify investor part, and after that, signing the PPM documents, and then transferring the funds using a wire.
And we'll also make this webinar, the recording of the webinar available on the portal for you to replay, revisit anytime later.
Right, and feel free to socialize among your friends who can benefit from this opportunity. Now I'll open up for questions. So there are 10 questions, so I'll see if there are thematic and then group them, and then we can open up the floor. I think you talked about this, the first one, which is, could you explain about the recent real estate growth in the area around Fairfax? I think you talked about the various brands.
I did, yeah.
Coming in the area, right?
Yep.
Yep, okay, got it. The next one is how much money has been raised. I think we talked about that too. Are there any prospective, scrolling. What happens if you're unable to get enough investors within the deadline? Okay, so that is a decision that we'll have to make. Once the investment money is pooled, we based on the interest that we have seen so far, we feel like we'll be able to meet the 1.5. But if it is less, then we'll have a discussion with LBX and Heath and move it as a single check. Or if for some reason where that is not something that makes sense, we will refund you guys the money. That's essentially how we go through the process. That's how this works. Is there any management fee by Rice Capital? We don't. There is no management fee by Rice Capital. Once the returns come from LBX and the investment, is a 90-10, and even there is no commission taken on the capital investment. When capital is returned at the exit, that capital comes back to you. Let's say you bought 2 units and it is 50K investment. You made the capital, when you made the investment, you made 50K, all 50K goes into the LBX. They make periodic distributions. When periodic distributions are made, then there is a 10% to Rise Capital, and the 90% comes back to you. And when exit, or even otherwise, if there is returned capital because they actually sold some piece of the property, in such instances, there is again no money taken out for returning of the invested capital. It will come directly to you as is. And any other distributions that are cash distributions beyond the capital, again, are split 90-10. The next question is, one moment. Are there any prospective tenants that you can share details around? I think you shared those, or is there anything else to share there?
Yeah, I didn't give
I see.
specific names, but just for confidentiality reasons, I can't. But yeah, I did give uses. So there are uses that are in the market currently.
Okay, got it. Who is responsible for sending K1s, and can you guarantee to send it before tax deadline?
So
All right.
guarantees, yeah. So we've never missed a K1 tax deadline before. We get them out pretty early historically. We try to get them out at the beginning of March. This year we were pretty good at that. I mean, you never know with the government if they're going to like you had it a couple of years ago where the government, when they changed the tax code, it meant like all new forms, and accountants everywhere were pulling their hair out. But yeah, we've never missed a tax deadline with K1s. We always get them out by we target well before April 15th. Let's put it that way. It's the other thing I'd say is we care a lot about investor experience. We want to make sure that it's a good one. So getting you K1s on time is a key part of that. And then reporting on a quarterly basis is also very, very important. So, typically reports and distributions are going to come in lockstep, and they're going to be, call it a few weeks after quarter end. So like, for instance, for this deal, we're anticipating that it'll be mid to late July that we'll, expect the first distribution to come, and a report will be, right along with that.
Got it. Thank you. What we do is we will be receiving, Rise Capital will be receiving one K1 for us because we made a single investment into the LBX floor. And we will be preparing and distributing immediately the K1s that for each of you as LPs. Okay, so the next one is, how did LBX source and acquire the property?
Yeah, it's an interesting story. So in terms of, kind of what I can say about it is the portfolio was, was brought to market and it didn't have, there wasn't like a big portfolio bid from like a Blackstone or somebody like that. So it enabled groups like us to step in and, basically negotiate with the seller. So, we went after the deals that we wanted to go after. I can't give a whole lot of details around, around the processes tied to that. I really don't want to, break any confidentiality rules, but it was not like it wasn't, I would say, a typical process. Usually what happens is if you buy from a REIT, for instance, generally what happens is, they'll bring one property to market. It's not like a big portfolio, and you'll be in the first round, and then if your bid is accepted, or if your bid is in like the top few, you'll go to the next round, and then you work your way, almost like when you buy a house, you work your way to the end, and then the winning bidder gets the deal. It was I would say a little bit of a different process here, but it was it was really because there was not one large group like a Blackstone or somebody like that to just buy the whole thing. So list price, there's a question here, what's the list price? It doesn't usually work like that. What happens is, so there was no list price. What happens is, company, when a property or properties come to market, you'll be given all sorts of confidential information, and then you underwrite it, and brokers are always going to give you numbers, and you evaluate whether or not you agree with those numbers, and you underwrite it and come to what you think is an appropriate value for for the property. There's another question here. What are the considerations on the hold period? So when we put a holding period out there, right, it's a target. And what we're basically telling investors is we're saying, look, like, we think this is how long it's going to take us to execute in our business plan. And our base case for this business plan is we think it'll take us 2 years. And then at that point, the expectation is to sell what we think will be a stabilized asset. Now, certainly our goal is to do what's best for the equity. That is always our number one goal, right? And so, if at that time, let's say the markets are, more favorable for a refinancing than a sale, we could potentially look at something like that and hold it for a bit longer. But, as underwritten, our expectation is to, add the value, stabilize the asset, and then sell in 2 years or after 2 years.
There's one about what is the comparison, sales comps, rental comps, and things along those lines?
You know what? That's stuff that I can. Yeah, I can put some info. There's information in the in the materials that you have.
Yeah, we'll answer that question separately. Yes. No problem.
Yeah, but I mean, we basically it's appraised very favorably, I would say, based on comps.
Okay, this one, there's one that says, do you have examples on completed projects where you delivered 20+% returns? Yes, there was one that was there in the earlier part of the presentation. I know this gentleman came a little late, so we can go rewind and talk to it. But do you want to give a top line?
Yeah, I mean, top line. So in terms of our track record, we have gone full cycle on one deal. That was a debt deal. So that was not, because it was debt. It was not 20% return. That was just basically, it was double digits, as advertised. But it was a debt deal, not an equity deal. On the equity front, we have a few different deals where we've done is we've stabilized. We haven't sold anything outright, just like a complete round trip in the portfolio yet. We have sold significant pieces of portfolios or of assets. So for instance, on just doing that round math, I spoke earlier about the Alafaya deal that we own in Orlando. We bought that for 20. We've sold off, I think it's 12.5. And what's left is worth 15, 16. Investors are done very, very well there. We have another deal in Alabama where we fully stabilized it, returned a bunch of capital to investors, and now their cash on cash is, oh God, I don't know. It's like, or I can tell you what it is. I think it's 28% cash on cash. It's really, hold on. I will tell you. Yeah, so we bought a deal in 2019 that had a JCPenney, has a JCPenney. It's 100% occupied. We sold off 2 out parcels, returned significant cash flow. It's now cash flowing at 28% annualized, and investors are already at 1.12x multiple, which means they invested $1, they've already gotten $1.12 back, and still own an asset that's cash flowing at a really high level. We have another deal that we did where we bought an LA Fitness anchored center. We bought that at about $11.5 million, and then we basically sold off the LA Fitness at close for like $9.5 million, ballpark numbers. So what's left is worth, I don't know, like $4 or $5 million bucks, and our basis is 2. So we've done deals like that where you've got investors that are now clipping, and like going back to the Alafaya one, while we're figuring out if we're gonna sell or refinance it, and while while we're working through that, investors I think Alafaya this last quarter was like 13% cash on cash, something like that, 14% cash on cash. So, what's nice about retail is because you have that positive leverage, you can continually improve your basis. And then when you get to that point where you need to, make an execution decision, right? Whether you're going to sell or refi, by that point, if you've executed, you generally have really, really nice cash flow, which is great. It's what, investors like. Speaking about that, there's another question. So distributions are on a quarterly schedule. So that's another question that somebody.
There's one more here. There are a few more. There's one that is asking about the cap rates. Maybe you want to talk about like entry cap rate and exit cap rates.
Yeah. So I can respond offline in terms of there's just, again, in terms of entry price and cap rate, I want to be careful in terms of what I reveal, other than, I mentioned this earlier in the call, which is it's been very hard to find attractively priced deals in Fairfax for a long time. So we're very excited about our entry point here. As far as, closing cap, we're modeling a 7 3/4 cap on the exit. And, that's after stabilizing at a yield that's, significantly higher than that. From our standpoint, we're being pretty conservative on the exit, but, that's what we try to do. If you go through our assumptions, we are, generally we're not aggressive underwriters. It's just not, we don't like to stretch. We want to make sure that if we're, targeting a return, that it's really, we'd prefer to, outperform to the upside as opposed to, be really aggressive with the numbers on the back end.
Got it. There is a question here. There are a lot of technical terms which are not clear. What is the hurdle rate, cash on cash? If someone invested 50K, what would be the target? Oh, okay. There is actually a very good blog. Okay, it is an anonymous person. If you can send me an email, nageshp@outlook.com, I will send you a blog that we've written. I'd really like you guys to please follow us on LinkedIn, which has very curated content, RealtySlices on linkedin.com, and only one article per day and highly curated content, which will be extremely beneficial for you to learn about a variety of topics related to real estate. And of late, we've been posting a lot about retail, multifamily, and how to look at investments, how to evaluate investments. All these is curated content from the net at large. And sometimes we have blogs that we've written. There are about a dozen blogs we've written in the past. And those are also good content for you to have so that you can get up to speed. Any other questions before we close? We still have, we're at time. Okay. All right. Thank you very much for spending the hour and a half with us. And hopefully we gave you a good color of what the investment opportunity is, what the project is, why it is an interesting project, and why you should consider it for your investments. Any questions that you have about the deadline and deadlines or how to invest and so on, please send email to ir@realtyslices.com, IR for investor relations. And thank you once again for spending the time with us.
Thank you, everybody. Thank you, Heath.
Thank you, Heath.
Thanks, guys.
Take care.